Okay, now we will begin the second panel. Good morning, everyone. I'm Zhongling Wang, Vice President of Power, Gas, Coal, and Renewables in Americas at IHS. I'm very happy to have three speakers with me, and that's Leo Birnbaum, member of the Board of Management from E.ON, and Don Farrell, who is CEO of TransAlta, and Jim Hughes, who is CEO of First Solar. For this second panel, we'll continue the discussion from the first panel, again on electricity business and its challenges and issues. We will expand the geography. We will also put special attention to solar, which in many people's mind is the possible next game changer. So with that, let me start with Leo. Even before we start Power Day, the issues in Germany's power systems have been discussed several times already. The nuclear shutdown, the renewables integration, the concerns for competitiveness. So let me ask first Leo to tell us about E.ON's business and what you see as the challenges and issues.
Yeah, and since you have asked me to do that in 2 or 3 minutes, I'm really kind of like overwhelmed right from the beginning. But maybe the point is to say, if I listen to the last hour, it appears to me that more or less we have, for different reasons, the same problems like the colleagues from AEP, AES, and Duke. Why is that? Because I think Germany is just amplifying some of the challenges that all energy systems are facing. And we just get them faster and more extreme, but actually what we see, you all will see going forward. And so if I put one challenge to the colleagues from the last panel on the table, and maybe to this panel to make it a bit exciting, I think we have to understand that, and that's the first strategic theorem of E.ON, that we have to deliver what our customers and society want. We tend to think too much in systems and engineering terms, and we miss the point that really the development of politics of regulation in the end is driven by politics, and politics are driven by society and customers and voters. And to that extent, I think we should have talked much more about what is it that people want, because they not always want the rational thing. So the first thing of E.ON is we have to listen much more what they really want. And E.ON, we have 35 million customers, 10 million, roughly 8 to 9 million in Turkey in a JV, and 25 across Europe, partially regulated, partially deregulated. But you have to understand what those customers desire. You have to understand how their desires are going to be translated into regulation and into politics. And therefore, I would also make a second point, and also tying it to the previous discussion, I think the notion of risk will become much more important. We just heard about an IGCC for $3.5 billion. If you were to build a nuclear station, you're talking $10 billion, whatever. Yeah? I think in a world which is changing so fast, you cannot make such investments if you're not state-owned. Right. We are actually a privately investor-owned utility, and our investors do not want us to bet $10 billion on one asset, in one regulation, in one geography. And therefore, I would argue that decentralized, distributed, modular is going to win out in every jurisdiction and in every system just for the risk standpoint. Even if you don't believe in the technological advances that are there, and I guess on solar, I'll just leave it to Jim to comment on that one, I think just for a pure investment standpoint, they are going to win. So we as E.ON, we become much more mindful also of the risk of making, let me call it, cluster investments. Yeah? And we're just going to see less of that. And therefore, I guess, I'm going to just finish on that one. Risk, customers, and society, those are the three key words that you have to address in your strategy. And then it becomes down again to the points of portfolios and cash flows. And this is where we really, really focus on. And if I might say one last point, we are fundamentally a political industry. If you say we deliver value to our shareholders, that's all fine. We can do that if politics let us do that. And then to actually get that license, we need acceptance, and we need to be perceived as adding something to the society. We have heard that from AES in the previous session. I think I would just emphasize that as a closing point.
Thank you, Leo. Next, let me ask Don. We talk a lot about the depressed power demand in North America. However, if we look around, Alberta has the highest growth, both the past and the future, and that certainly ties with the boom of upstream development. So you've been serving the hottest, fastest growth area. What are the challenges that you see?
Yeah, I would just like to pick up on what Leo said. You know, TransAlta is involved in markets across Canada, but primarily in Alberta, but also in Western Australia and then some in the US. Two of our markets grow by, you know, the Western Australia, there's a lot of mining business going on there, lots of investment in order to serve China, growing very quickly, low unemployment rates, 4.5%, hard to get people. Alberta, our power demand's been growing by 3% a year. We're building lots of oil sands projects there, again, 4.5% unemployment. So going to the theme of what do customers want, it's actually very interesting when you start to actually ask your customers what they want. It's very different in different jurisdictions. If you're in Alberta, for example, we did a survey last year with our customers to see what they felt about coal. Now, if you read the papers, you would believe that everybody in the world hates coal plants. But in Alberta, because we're growing so quickly and we need to serve such a high level of demand, 70% of Albertans would see a transition away from coal, but over a 20-year period. And they see the transition, and I think it's because they believe fundamentally that other forms of generation are more expensive. They see what's happened in Europe. They see what's happened in Ontario. They don't want that for Alberta, because primarily for us to compete, we have to keep our costs low, and most Albertans are working for companies where, you know, they're struggling with cost pressures. So cost, reliability are ahead of the environment at this point. Now, what's interesting for me is I do believe fundamentally that the technology is changing much faster than we've ever seen in our industry. And I do think that as we've actually been able to build about 1,300 megawatts of wind in Alberta without any subsidy, right? Within a market construct. There isn't missing money in the Alberta market. And so that's been able to bring on renewables. And I do think I'm really interested in hearing what Jim has to say about how the cost curves are coming down for solar, because I think as those cost curves come down, customers will start to change their views, and we as an industry have to keep up with that.
Thank you. And let's turn to Jim. Jim, on oil day, we talk about solar. And on gas day, we also talk about solar. Joe Kaeser, the CEO of Siemens, who opened our gas day, talked about solar in Germany is equivalent to growing pineapples in Alaska. So I'd like to hear your take on both, you know, the solar, the cost, the trends, and the future, as well as where are the opportunities?
So the biggest challenge that the solar industry faces is really one of education and understanding on the part of the consumer, the regulators, and the industry itself. Most people, when you speak of solar, they have a single impression in their mind of what that means. And it varies among people. Some people may have an impression that that's a 4 kW system on a rooftop. Some people may have an impression that that's a 500 megawatt facility in the deserts of the western United States. Some people may have some sort of impression that's in between that, but they generally have a single impression of what solar is. The reality is that solar, as with other generation technologies, comes in a bunch of different flavors and a bunch of different applications. So we don't pursue every segment of the solar industry, but within our company alone, we have our core historical utility scale generation. We pursue commercial and industrial, both free field and rooftop. We pursue the energy access business, which is rural electrification. And we look at hybrid installations or fuel displacement opportunities. And there's each of those applications is dramatically different. The driving economics are dramatically different. The constraints to future growth are different. And the regulatory understanding and the industry adoption, issues are different. And so the reason you hear about solar on oil day, gas day, power day, and you will continue to hear about it, is that the economics are beginning to work in a greater number of circumstances. And there's a great deal of, I wouldn't say confusion, but there's a huge learning curve that people have to come up to understand that there's all of these different applications. There are different winning technologies in each of those applications. I often equate it to people have learned over time that in the wind turbine world, different manufacturers have different technologies that are better in one particular resource regime. The same is true for solar, depending upon whether it's hot, whether it's cold, whether it's dry, whether it's humid, whether you're space constrained or have adequate space, whether your priorities on low cost of electricity or energy density. That generates a different technology answer from all of the manufacturers that are in the space. So I think the challenge for solar is, one, as an industry, we need to do a better job of being a responsible member of the overall sector, okay? What has happened in Germany is not a good outcome for the solar industry, all right? To destroy, not destroy, but significantly damage the creditworthiness of the utilities, to drive the cost of energy to the point that it hampers industry. Those should not be goals of the solar industry. And some elements of the industry engage in what I call open warfare versus utilities and make statements that they're out to destroy the utility business model. I can't possibly think of anything more absurd. We can't have a functioning economy, and we won't have an opportunity as an industry unless we continue to have well-funded, well-operated grids and participants across those grids. There is ample opportunity on the distributed side. There is also ample opportunity on the utility scale side and a bunch of different flavors in between. And so we need to work as an industry to get the education to the point that policymakers, regulators, industry adopters all have a greater understanding of what it's going to take to allow that penetration into the system.
I just want to add on the pineapple in Germany. So indeed, Germany is not New Mexico and Arizona. When it comes to solar radiation, it's indeed like Alaska. But I think the point I would like to make is a build on what you said, Jim. I believe if we were to abolish all subsidies for solar in Germany now, we would still see an addition of PV, because the industry would figure out ways to actually add capacities without subsidies. And on the point of education, I think also the industry, the solar industry, would need to educate itself that it can live without subsidies. It just got so addicted to it by getting it everywhere.
I don't. You certainly from First Solar, you don't hear any disagreement.
I know. So just making the point. But I also want to make the point: if somebody in this room believes that solar is a subsidy game which is going to be over once the subsidies go because people see the reason, wake up, it's not going to happen. Solar is going to be continued to be added to the system, and we have to figure out smart ways of integrating it.
Now, speaking of solar adding to the systems, we also are taking things out of the system in many places, including the coal phase-out in Canada and the policies and EPA rules in North America. Let's think about the fuel mix, and the diversity issues. Where are we heading? Leo, you talk about what the customers want. Do these policies actually reflect what the customer wants? There's variations from Germany to UK, but let me start with you again, Leo, on the reflection on where is this fuel mix going?
Yeah, the reality
are
is...
Are you comfortable with it?
I don't know is the answer, because we just heard coal is going to go away, but in Europe it actually came back last year. Yeah? I mean, I think whatever walked away in the US just walked over to Europe, right? To a certain extent, I really don't know. But I think the trend, the fundamental trend eventually will be that we are slowly moving away in developed countries from fossil. But if you look at the World Energy Council scenario, for example, on the global developments until 2030, we just see that there will be massive fossils still there, and we heard it in the previous panel. So I think a general answer where the fuel mix is going to be is very hard. Regional-wise, you will see development and fundamental trends. And those fundamental trends in Europe clearly will point towards more renewables. Yeah? But if somebody today tells me there will be more nuclear, I will say, well, let's just wait 10 years and we'll see. Yeah? So to that extent, I would argue one would need to be very much more specific. What region am I talking about? What market am I talking about? What's the need of that market? What is the industrial base in that market? What are the economic conditions in those markets?
Yeah, I mean, if you look at Canada to that point, British Columbia is hydro because that's the natural resource they had there, and so is Quebec. Alberta was coal, and so was Saskatchewan. Manitoba was hydro. Ontario actually built their nuclear business because they didn't have anything. And so nuclear became something that their population would accept quite willingly and openly because that gave them low-cost power. I think the theme you see as you go across Canada is people absolutely want electricity. They want it to be cheap. They do not want it to be expensive. They would like it to be environmentally better than what it is today, but they also absolutely want reliability. And I think the value of that diversified portfolio has been should never be overlooked. I mean, it is critically important. And I do think, as you think about the growth, our market will be twice the size in 5 or 6 years. Many markets, I think, Larry asked the question, what are we going to be talking about next year? What we're going to be talking about is the demand response in the U.S. as the industry takes off here, and the fact that none of the infrastructure has kept pace with that, and there's going to be shortfalls. And so my belief is that that diversified portfolio has served us well, and finding a way to have a policy environment that continues to encourage that is important. In Canada, we shut down our coal plants now after, for some of our coal plants, it's after 48.5 years on average. Some are 50, some are 45. They don't have to be shut down. CCS can be applied to them, so there can be a technology change, but they have to meet the CO2 standards of a natural gas plant.
And you don't see the coal phase out as an issue, and what do you replace it with?
Oh, I think it is an issue because I think in Alberta, phasing out coal will quite naturally put you more onto natural gas. And we just saw what happened here this winter, and that would not be something we'd want to have happen in Alberta. So I think the conversation will continue in Alberta about just how do we handle that change in capital stock.
And what are your options? You know,
well,
if you phase out coal, you're obviously not in nuclear yet. So.
Well, I mean, one of the great things about Alberta is because it's a lot of our development is in the oil field, in the oil sands. There's quite a bit of option for cogeneration. That is gas, but you end up with a lot of efficiency with that. Wind has been quite economic in Alberta because of the way our market works. You do get the proper signals for that, and it turns out that wind has been able to live without subsidies, and we're continuing to see wind farms built today without subsidization, with just market signals. But it is a tough, you know, you have to build some large combined cycle plants. The economy will be much more reliant on natural gas, and I think we have to think about what for TransAlta, for example, for some of our plants that need to phase out towards the end of 2020, just at 2030, I think there's a good chance we'll be investing in some CCS to extend the life of those plants, because the diversification will enable us to do that.
And Jim, you know, so many countries are trying to, or in the process of incorporating solar, as you alluded to earlier, for different circumstances. We certainly see California with very, very good resources racing to add solar, but what we also see, not just Germany, but like Japan, for the necessity, is pushing for solar. So where do you see are the big opportunities there?
So we see big opportunities a lot of places. What I like to tell people is, let's just take the U.S., right? So the U.S. is on a true market basis, the lowest cost natural gas market in the world. Yet we are increasingly seeing our utility customers, including solar in their procurement processes, and asking their public utility commissions to support the addition of solar either on a PPA basis or a UOG basis. The most frequent argument we hear runs along the lines of the cost is much lower and going to continue to get lower. But two, and of critical importance for our industry, is fuel diversity. As they phase coal out in the face of regulation that is making older plants increasingly expensive, largely they're adding incremental natural gas-fired capacity. And as their exposure to natural gas increases, when they go through their normal resource planning process, this is not some subjective judgment. This is when they run various gas price sensitivities through their resource planning processes, they get some scary answers in the high gas price scenarios. And if you add some solar, one of the beauties of solar is when I sell you a plant, I give you a flat power price with no commodity price risk for 25 years. You know, that is a valuable hedge in a portion of their portfolio against commodity price risk going forward. So we see this desire for prudent diversification of fuel risk as driving decisions, and they have nothing to do with renewable portfolio standards or anything else other than we need to look at what is the lowest cost way we can diversify our fuel risk going forward. And increasingly, we're a small part of the answer to that question. We don't pretend to be the entire answer to that question. We don't pretend that we're going to displace fossil entirely from the grid within my lifetime. That's simply not going to happen. But we believe there is a value proposition that you get as a byproduct of that value proposition, a very clean generation technology, but the core economics also work for our customers and for their end customers, which are the consumers. So as I think as for everybody who has suffered through a very cold winter, it's had an incredibly positive effect for the solar industry, which may not be intuitive in that we've seen challenges on the storage front, we've seen challenges on the delivery front, and everybody has become acutely aware of their exposure to natural gas, both physical delivery and price risk. And that is driving people as they begin to look at procurement going forward to say, okay, what are the options to provide fuel diversity across our generation portfolio? So we see it as a positive. And there's some interesting analysis. One of my favorite analysts at Credit Suisse, a utilities analyst named Dan Eggers, did a very long report. The conclusion he came to is that over about the next decade, 85% of the new generation will be renewable. And that's based on existing RPSs, not new ones, existing RPSs, the replacement of coal as it is taken off the grid, and this fuel diversity issue and the core economics. So there's a growing number of people that are sort of recognizing that as we change the generation mix, we can't go 100% gas-fired capacity. We've got to have some fuel diversity in the mix, and that's going to benefit the renewables industry.
Jim, you talk about the advantage of solar. You give people a fixed price for 25 years. So what kind of prices are you giving people?
Well, prices vary dramatically across the globe. It depends on the irradiance, so the solar resource that you have available to you. It depends upon the constructability in a given jurisdiction. You know, the soil conditions are a heavy component of utility scale solar cost. It also depends quite heavily on cost of capital, which is not something that people recognize. So whereas a gas-fired plant, maybe 50% of your cost is fuel input, the other 50% is your capital cost and cost of capital. Solar has no fuel input, so it's 100% capital cost and cost of capital. So we've reached a point where a lot of the future cost reductions are going to come on the cost of capital side of the equation, and we're seeing that. But in recent California RPOs, the prices you've seen have a 6 on the front, and we've have seen very recent experience around the U.S. with prices with a 5 on the front, prices that are clearly competitive with simple cycle gas-fired generation on a marginal cost basis, and competitive with combined cycle gas-fired generation on a full cost basis. Now, those prices won't be applicable everywhere in the country because that's where you have a superior solar resource and all of the right combinations of factors to deliver that. But prices are clearly getting to the point where it's getting people's attention who probably never thought they would be contemplating solar. And getting their attention not from a climate change policy-driven aspect, but purely from an economics aspect.
Well, let's talk about a closely related issue with fuel mix and incorporating solar and other renewables. That's the power market design or the power pricing, including for solar. We've already talked about the missing money problem. It is in many places, Europe, US, and other places. Let me start with Don. You have this energy-only market in Alberta, and then you have this very fast growth. I think many people have observed, us included, that the competitive power markets typically don't pay enough to stimulate new build, and increasingly in North America and in Europe, not even paying enough to keep the economic existing plants running. So what's your experience and what's your take on power market design?
Yeah, I would say that generally overall, all of our survey has shown that energy-only markets, as they've come into being, have definitely not created enough capacity payment to be able to fund the kind of capacity you're talking about if you were building a solar plant or a wind farm or a hydro facility. We have seen in Alberta, there's been a lot of work done in that market to try to ensure that we have a situation where the market clearing price does replicate long-run marginal costs as opposed to short-run marginal costs. So a lot of work on ensuring that there's dynamic efficiency in the market over the longer term. That's resulted in an average price over 14 years of deregulation of around $66. So it's not quite what you need to get a new combined cycle gas plant built, but not bad. It's not what you're seeing in Texas. So we've had some good results with that. And as a result of that, for the most part, we've kept up with supply and demand, have kept up with one another, and we've built a lot of generation in that market. I think the challenge we have, though, is the market has been, we've had long-term power purchase arrangements that were set up at the beginning of deregulation to ensure that there was no market power by any participant. Those long-term contracts gave us a lot of contract cover in our portfolios and allowed us to build some merchant plants because we already had a good, thick set of contracts. They begin to roll off, and we really begin to face a truly deregulated market as we get into 2020. And I think the biggest challenge is, it goes back to your financing concern, is what I see is the way the market is structured today is people who want to build new projects in Alberta, they'll look more like mining projects, or they'll look more like oil and gas. You'll only be able to afford about 25% debt. You'll need 75% equity. You'll need a different group of equity holders. That'll be a different cost of capital than what this industry has had in the past, and that ends up with higher pricing than what consumers have seen. So, if you look at the spectrum of the way electricity is procured in the world, all the way from regulated utilities building it for themselves to regulated utilities going out to the market for contracts, all the way through to a very deregulated spot market in Alberta, it's going to be interesting to see what customers really want. Because my view is customers want very stable. They actually didn't mind the regulated business where things were stable and prices were stable and rates rose a little bit at a time. I think most customers think about that for electricity more than they think about a market where technology is changing, prices are changing, cost of capital is much higher, and you're investing in something like a mining company. So,
Leo, what's your take? In Europe, different countries have different ways to mitigate the energy-only market, and Germany different from UK. Any thoughts about where are things going?
First, I guess when we established deregulated markets, the focus was on breaking up the monopolies or the oligopolies which we had in place, and therefore the focus was market power shouldn't occur. We need to make sure that prices are as low as possible. We do an energy-only market in which you can bid in only short-term marginal cost. You can't bid anything on your fixed cost, etc., etc. And we are realizing now that once the market is either stagnating and capacity has been taken out, or when it's very fast growing and needs new capacity, such markets such as sole focus on on making them as low as possible on the price side isn't probably going to provide you the incentive. So that's the first take that I have, is the regulators will need to balance their objectives in certain different development stages of the market. And number two is, if you hesitate too long, regulation becomes self-fulfilling. What happens is then somebody says, well, the energy-only market doesn't pay for it. Then politicians start to talk, well, the energy-only market doesn't pay, so we need a capacity mechanism. Then the investor says, oh, wait a minute, I'll just see how this plays out, and I won't invest before I know how it works out, because I don't want to be the one who doesn't get the payments because he invested too early. Then politicians are going to say, well, they don't invest, that's a market failure, I need to do something. And then self-fulfilling, you get capacity mechanisms because it won't work in energy-only markets. So what I would argue is there isn't a right solution. If you have reached a certain stage, it just is a dynamic that you have to live with. And this is currently the situation that we have in Europe. Since everybody talks about capacity markets, we will need some capacity mechanisms. There's just no other way. And it's actually different from the US. We have close to 3 gigawatts of wind actually in the US. And there we were perfectly fine to put a third into the merchant market and 2/3 into PPAs. No problem, but we would be very hesitant to do that actually in Europe. So my takeaway, there isn't a single answer, but maybe in a more general sense, in the past, whenever I built a power station, I provided for capacity and for energy. Now, with the additions of renewables, I have actually decoupled capacity from energy, which means now I have two markets, while in the past it was only one unified market. And that somehow needs to be reflected in whatever market design that we are going to have in 10 years.
Perhaps we'll zoom in around renewables. The mechanisms to include new renewables in Europe, there are different ways, and now we have UK using a carbon floor and contract for differences, and others are staying more with the feed-in tariffs. Any thoughts about the direction, pros and cons? And I'll go to Jim on that as well.
Yeah, I love what you just said, that there is an economic reason to add renewables, because I think this is the path that we have to follow in the long run. It's the only path that really makes sense. I personally believe that feed-in tariffs, now I take my German hat for a second, feed-in tariffs are okay for niche technologies that don't take system responsibility, and it's fine if a niche isn't taking up any or picking up any responsibility. But once the niche becomes more and more the majority in many hours of the system, it needs to take system responsibility. It needs to actually deliver also stability to the system. Feed-in tariffs do not provide any economic incentives, so they can't be the solution. No matter what the arguments are, they can't be the solutions. They can be the solutions up to 5% of the market, maybe up to 10%. But if you go to 40%, to 50%, like we have in many hours of today already in Germany, we cannot live with feed-in tariffs. There needs to be something which is market reflective.
Other reflection?
We agree. So First Solar has been relatively vocal that completely agree with what Leo said in terms of small niche technologies that need the opportunity to achieve some degree of scale can be effectively incented with the feed-in tariff. But the challenge with the feed-in tariff when it gets big is there's no competitive element to it. So as it begins to achieve scale, the cost reduction accrues to the developers and manufacturers, not to the system and to the consumer. And that's a pretty fundamental flaw. It's also, there's no gating because it's not competitive. So it's, you know, I describe it as a limbo contest at a party. You know, everybody wants to go around the first time because the bar's real high. The inevitable policy response, we've watched this happen in market after market after market after market, and now it's happening in Japan. You have very high feed-in tariffs put in place. An overwhelming response to those feed-in tariffs. A piling-in effect. Alarm on the part of the government, alarm on the part of policymakers. So they decided the response is to begin ratcheting down the feed-in tariff. The limbo contest begins. What happens is that merely accelerates the rush, because now you have created an incentive on the part of the market participants to go fast. You know, it's a game of musical chairs, and you want to make sure you have a chair before the music stops. And we've watched this happen. We've now seen in Japan, they have a very lucrative feed-in tariff. They've had a tremendous response, although I can, given their issues with the tsunami, there's some justification for the decision making, but the pattern is consistent. You've now seen them begin to talk of ratcheting down the feed-in tariff, and you're going to see this rush to participate. So we prefer structures, regulatory structures, market structures that are more sustainable. And so we like to see, one, structures that work through the normal procurement and planning processes of the utilities or the system operators, okay? There has to be some contemplation of what's going to get built, where it's going to get built, and what its operating characteristics look like. That there is some obligation on the part of the resource to be grid friendly, so that it's not simply negative demand. It is some sort of resource that can be seen, felt, and predicted. That there be a strong competitive element, so that as cost reductions are achieved through scale, the consumers and the economies and the systems see the benefit of those cost reductions through competitive processes. It also eliminates the marginal providers and makes sure that only the best and most viable providers participate in the market. And lastly, that the funding mechanism be market-based. You can make choices to facilitate and enable green energy, but do so on a basis that is clearly funded on a sustainable basis at the consumer level. In other words, if you want to have green energy, the consumers of the energy need to be willing to pay for it. If you have it as a purely political funding mechanism, apart and separate from your energy market, what we've seen globally is that those are subject to the whim of the political winds and can change radically at a moment's notice. Best example currently would be Australia, where they've done a complete 180 with respect to their green energy policy, and that's partly, they can do that 180 partly because of some of the way the programs were structured. So we would much prefer, you know, we fell victim to it first time around. We built 2 manufacturing facilities in Germany, and we're enthusiastic participants in the feed-in tariff programs, only to watch the market completely disappear on us. And we've since closed those facilities. So, you know, lesson learned for us, before we're going to invest in manufacturing capacity, we want to see a market that we believe has the characteristics of long-term sustainability, as opposed to short-term incentive that inevitably is going to dry up and go away.
Yeah, you know, if you think about our industry, when we're getting ready to go into our strategic planning part of the year, and the thing I think we're grappling with is what Jim talked about, which is historically the way that you created value for customers is you took something that was either free or that you couldn't use for anything else. So if it was free, it was water that was running, it's air that's blowing over the wind, or it's the sun. And if it couldn't be used for something else, it was usually coal reserves that couldn't be exported anywhere else. You know, it was mine-mouth coal. You couldn't put it on trains and send it to China. You could only burn it there and make electricity out of it. We historically invested in large projects where we got lots of economies of scale. We historically had regulators who gave us small rates of return for more certainty, or we got into long-term power purchase arrangements, which gave us very big benefits in terms of financing, and all of that created electricity for a low cost for people. And then you built a system around that. The other paradigm which we're thinking about is this distributed paradigm. What if rooftop solar comes down much lower in price? What if people really do want to bypass all the elements of the grid and have something in control on their house? What if you can get smaller and smaller units? What if in your energy-only markets like in Alberta, you have to be able to compete in that market without long-term contracts, and therefore you have to set up your business structure as if you're in more of a commodity-natured business? And that goes to what you said right at the very beginning. You can't take on $3 billion projects in scenario 2 because you can't afford those projects to be written off 3 years from now when the feed-in tariff doesn't work anymore and you have to shut that plant down. So we're kind of at this very interesting crossroads in our industry, and every single model, every market, every regulatory regime, everywhere across all our markets are different. So if you want to be in Alberta or Ontario or Germany or Northeast US, you have to be able to understand and interpret tons of different rules, different reactions by politicians. So all of that is at play, and it's really what's the bet? What's the bet that we should make for the next 20 years?
Just one comment,
What's the bet?
Well, one of the interesting things is the discussion on energy-only markets. So I think to a certain extent, with renewables particularly, there's going to have to be a period of what I'd call experimentation and see what happens. So it's very difficult for me to criticize energy-only markets when in 2 energy-only markets we are building merchant plants today. So we're actually building capacity based on what we perceive the long-term economics to be in those markets. Renewables react differently to an energy-only market than fossil does. When I build a plant, I can build it in phases. I can build it small and expand it later. I have a total full cycle, even at a utility scale plant, of less than 2 years. My permitting challenges are dramatically less, whereas a guy who's going to build a gas plant is looking at a full cycle development of 4 to 6 years, depending on the jurisdiction, and coal, infinity. So we produce revenue immediately because we turn the plant on in blocks as we build it. So the economics of renewables look very different, and the risk profile looks very different, okay? A thermal asset built into an energy-only market can become completely stranded and turn to a zero. It's one of the single biggest risks of thermal assets, and I've personally experienced a gas plant that turned to a zero. That doesn't happen with a renewable asset. Your marginal cost of production is zero. So your risk is that you have an inadequate return on invested capital, but it's not that you have no return on invested capital. And that's a significantly different risk profile from what the industry is used to. And people are still trying to get their heads around, what does this really mean, okay? I can go take this risk, this merchant risk. It's a long-only position in an energy-only market, but it's never going to be a zero. I'm always going to have some revenue. And there's a huge element of optionality. I don't have to tie up a fuel contract to play that optionality. It's inherent in the asset itself. And so how we value all of those elements of a solar project in the context of an energy-only market, we certainly don't know. We're experimenting. I don't think anybody really knows. And so as the characteristics of renewable assets, wind, solar, and the others, begin to be more well understood and play in some of these market structures, I think there's a lot of learning to be done on the part of the industry. There's a lot of learning to be done on the part of market regulators, and I think we're going to see a lot of experimentation with market design, and it will be an evolution. I don't think we know what the answer today is. We're going to have to watch how markets develop to really understand what the appropriate market structures are forward. I certainly don't believe I have the magic pen that I can get up on a whiteboard and tell you, here's the perfect market structure that's going to facilitate renewables and the lowest cost for the customer. I think it's going to be a commercial technology type of evolution where we learn and understand what the right market structures are serially and incrementally over time.
Fascinating insight that you always have the going forward positive cash flow compared to fossil. Now, we have quite a few questions related to solar and its operations. I think solar has limited experience. Maybe it's a newcomer. So we have questions about Leo. E.ON paid more than $1 billion for renewable business in North America 5-6 years ago. How is it doing? And let me turn to you first, but also turn to Jim. Your portfolio globally, how is it performing, both in terms of the operations, the solar physical operations, and as well as financially?
Maybe I'll answer in a second, but I would tie to what you just said. It's my first comment, right? It's about customers and risk return. The risk component becomes more and more important. Also, from a risk standpoint, in the past, we made more money if we invested more money. It's simple. We got a return on capital employed, so more money in the ground, more return, period. Yeah, and you put it all in the regulated base. And that is just over. Actually, today, more invested capital in the first sense means more risk. Now, the fascinating thing is that there's a different ability to attract other capital into your assets. Grid business, regulated grid business, you can get very, very competitive debt because of the, the risk-return profile. And actually, the utilities in Europe are not the best owners of capital anymore, or providers of capital anymore, because they have higher cost of capital compared, for example, to private investors who, for example, have a completely different way of looking at their risks, sometimes even a foolish one. Yeah, we just had some bankruptcies in Germany where investors, followed 8% guaranteed returns and figured out 8% guaranteed returns without risk don't exist. It's risk return, and it's who can actually provide the capital, and in many cases, it's not the utility anymore. And in renewables, you can get capital. In merchant fossil, it's very hard to get capital. So also your ability to mitigate your risk position is very different, not only from the nature of the asset, but also from the ability to actually get partners in. Now, when it comes to E.ON, yes, you said a few years ago we entered the US market. We are now close to 3 gigawatts of capacity in the US. It's actually out of 5 gigawatts of renewables, and then we have something like 6 gigawatts of hydro in Europe, and then another 30 gigawatts of other assets. We consciously invested a lot into the US because from a risk-return standpoint, it allowed us to build assets of scale. It allowed us to actually rely on a regulatory regime which was a bit front-end loaded and not like Spain, you need stability for 20 years. And therefore, the money that we have invested, has paid off because we have built something around it. And since now our position became so large that we have in generation, we are also now trading on the gas and power side, mainly actually in PGM and ERCOT markets, which is a bit related to the assets that we have. So we are satisfied with what we did, but it was a risk-return analysis. We looked at where do we add our capital, and then we went into the markets which were most promising, and actually Germany was not the market, because Germany added a lot, but the cost of capital was actually, the capital was actually provided by private investors. They have the choice between a German state bond and a German grid bond. The grid bond delivers 5-6% pre-tax, the other one 1-2%, so all the money flows into renewables. And then you as a utility, you look at it and you say, I stay out of this. I stay out of the financing at least.
Jim, how are your assets around the globe? How are they performing? And
the beautiful thing as I came into this industry is there's no moving parts in a solar power plant. There's no turbine overhauls. There's no compressor disc failures. There's no foreign object damage. There's you can't leave a screwdriver in an inappropriate place in a large piece of rotating machinery.
But there are windstorms.
There are windstorms, but the risks are fairly manageable. The operations of a solar plant are all about optimizing. It's not an intuitive process to maintain a very large utility scale solar plant. You don't go fix every fault when it first manifests itself. Recognizing that some of our plants are, 7,000 to 8,000 acres in size. So it's all about having algorithms that accumulate faults, and then you fix clusters of faults when it's cost effective to do so. But broadly, all of our assets in the industry as a whole, we're not unique. Assets are performing as anticipated. We all learn a little bit about the resource and how weather conditions can make slight tweaks in how we're going to respond to the resource. But broadly, as an industry, they are not. There's not a lot of moving pieces, and we all generally understand pretty well how they're going to perform.
And June, I don't know how it is, how the stock market reacts to that, but one of the things that we did last year at TransAlta is we have about 1,000 megawatts of wind, just over 1,000 megawatts of wind, and we gathered it together and did an offering against that vehicle, just $300 million. So we now have a second currency in our company. We have our main company. We own 80% of what's called TransAlta Renewables, and the market can now own 100% of a wind piece of equity paper, and the market really likes it. We found our retail investors really like that vehicle, and I think it's because it's very simple. They can see, wind. They can see there's very few moving parts. They can see the cash flow. There's long-term contracts associated with it. They understand the cost of capital. So it's been an interesting evolution for us to have that vehicle.
Yeah, those emerging capital vehicles are the hottest topic. Every equity analyst asks me, the first words out of their mouth is, are you going to do a yield co? So we've got Pattern Energy that's out, TransAlta that's out, NRG Yield that's out, and Abengoa has filed, SunEdison has filed to do IPOs of vehicles. So I think you're going to see these standalone long-term ownership vehicles, and the cost of capital that's resulting from those vehicles is very, very low. Yeah. Sub-utility, it gets back to, it's putting us in a position that's a little bit non-intuitive and counter to our whole regulatory structure, where the utility doesn't have the lowest cost of capital. NextEra Energy Resources gets asked constantly if they're going to do a yield co, which is a bizarre thought to even think about. Because they are a yield co. They're a dividend-paying utility. Yet, even they, have acknowledged that there's a potential that there may be upside, because certain of their assets are viewed as so low risk that they would be given a very, very low cost of capital in the marketplace. So I think we're going to see this emerge as a long-term trend. I don't think any of us understand what the full unintended consequences of that is going to be, but there will be some, and we spend a ton of time thinking about it and looking at it and trying to make sure we understand it, but it is clearly a trend that is at least here for the near to medium term.
We have a few questions in this general cost of capital and financial areas. Let me turn to Leo. Many of the European utilities have lost, a huge chunk of their value. I think E.ON is, one of them, losing something on the order of 80%. What happened, and what do you do to turn it around?
Yeah, it happened all before I joined, so.
What are you doing to turn it around?
I was just lucky. It's all about timing. No, the reality is, it's clear now. We haven't talked about the nuclear shutdown, but if you just lose billions of assets, and in this sense, really, you lose 10 billions on your balance sheet, yeah, you're going to feel it in the stock price. Period. Yeah, and if on top the generation margins just evaporate, yeah, then basically it means that this is just going to be factored into the stock price. One has to say also that then in the case of Germany, for German utilities, there was an additional overreaction because the sentiment is doom and gloom, and a bit the discussions yesterday also reflected, like Germany must be a third world country tomorrow if you listen, because it feels like they're going to lose every advantage that they have. And I think that was exaggerated to a certain extent. But clearly the stock price was a reflection of the conventional fleet losing its complete value in nuclear for a special reason and in others just for the market development. But again, what is then underestimated is also that in our long-term planning, conventional generation, is just 15, maybe 15% of our EBITDA. It's actually on the same level as our existing today's renewable business. But there is a certain, like big conventional generation equals big utility, equals E.ON, and therefore you have a problem, even though 85% of your business is either regulated or grid or retail, which is just completely out of these areas. I think that will eventually be factored in. So the reason for losing is we've paid it on the fossil side. It wasn't driven by the renewables. We might have overpaid for some projects. We paid our learning money, but it wasn't even close to what we have lost. That is all driven by the conventional side.
And down for TransAlta, where do you see the growth opportunities, and what kind of return are you?
Well,
expecting?
We see, of course, we see growth in the Alberta market just because there's good organic growth there as the market, builds out the oil properties, and I think there's even more reason now to believe that is so. It's a very fast-growing market. Starting in the next year or so, even coal plants start to shut down. So we have 3% growth and coal plants shutting down, so there's lots of work to do there. We're also involved in Western Australia. We've built a nice niche business over there where we're the behind the fence with the mining industry, and we just watch that business and try to get a power plant every couple of years and build them and work with the miners. So that's been a good business for us. Our renewables business, we started that business in 2000. We bought a small wind company, and we've been able to really build that up over time, both through acquisition and greenfield. And we see that as growing TransAlta renewables would be sort of their third rung of the ladder. There's some good opportunities for gas-fired generation, cogeneration in Alberta and BC, as there's different large-scale developments there. Those are developments where they do need large-scale baseload type equipment, lots of capacity, sort of 24/7. So that's where we're focusing.
Well, let me, as chair, ask one last question. That's the same questions as Larry asked in the first panel. If we imagine that we are here on stage again in 2015, what will we be talking about? Anything new? Leo?
Well, I'm sure we're going to be surprised in this industry, because if there's one thing we are up for in exciting times as executives, we won't be bored in this industry for a long time to come. So there will be a surprise to be discussed. I'm not exactly sure whether in the next year. I think one of the things that we will really discuss is what are the regulatory answers in the different markets that are emerging to address the different challenges on net metering, on capacity mechanisms, on energy-only markets, on renewable subsidy regimes or non-subsidy regimes, etc. And I think what we will discuss is that. And I guess, and then we will discuss again all the same topics, politics, customers, risk.
Yeah, I think we always, in our industry, seem to talk about the same things all the time, but I think a little bit, what I watch are, first of all, where are the baby boomers and how old are they? And the youngest baby boomers, I think, are now 55, 56, they're starting to retire. And I think as they retire, that's a big swath of people that have generally tended to set the trend. And I think as they go into retirement, they're going to be conscious. They have to have their portfolios, their investment portfolios. So I think we'll actually go into a more pro-business type environment for the next 10, 15 years because they need those returns. They have to have low costs on their utility bills. So I think there'll be a lot of discussion around making sure that prices are right. I think we're doing that exactly at the same time as the fleet is 50 years old. So a lot of retirement's coming from the fleet. As the boomers retire, their fleet is retiring. And it turns out they're going to still need electricity in their retirement. So I think this aging infrastructure is coming closer to us than we can see. And then I believe fundamentally the U.S. economy is improving dramatically, much more dramatically than people think it is. I think it's been pushed down by what's been going on in government here. Underneath that, there's been a lot of change in industry. And I think as the economy picks up, the fleet starts to retire, the baby boomers get older, there's a lot of change coming our way, and we have to position ourselves to make money in that.
I think, to me, the $64,000 question is what's global economic growth going to do? Because we're now reaching a point where there's a lot of people in industry that either have forgotten or frankly have never seen how this business changes when we reach a period of broad global economic growth. So if we're sitting here in 2015 and Europe is starting to recover and the US is clearly recovering and the emerging markets have recovered from kind of the currency adjustment of the US backing out of QE, when everybody goes into procurement mode at the same time, our industry changes rapidly and dramatically. And we haven't seen that for nearly a decade when you really and truly look back at the last 10 years. And if we get again in the 2015, maybe 2016 timeframe into a position where the European market, the US market, and the emerging markets are all broadly seeing solid economic growth, and accordingly, through a combination of economic growth and coal retirements in Europe and North America, where everybody's in a procurement cycle, I think a lot of us have forgotten what that feels like and what that's going to look like. I mean, I remember the days where a delivery position on a turbine was a valuable commodity that you could trade in the market. And we haven't seen an environment like that in a very long time.
And thank you all for your great insights and for a great discussion. And let me invite you all to thank our panelists.